Well, it's great to be here today talking about REITs with my good friend Mark Kenney, CEO of CAPREIT, especially during a period when the REITs are actually having a really good 2025. Our Middlefield real estate funds are up by about 9% year to date, certainly thanks in part to our core holding in CAPREIT. So we thought it made good sense to get Mark in to really talk about the state of the union in the REIT sector generally, with a particular focus on the multifamily REITs. So thanks for joining us today, Mark. I'll just give you a bit of background on CAPREIT. For those of you who are less familiar, it is Canada's largest REIT, $7 billion market cap, 50,000 units in Canada, as well as some in Europe. By comparison, the next largest residential REIT's got about 30 to 35,000 units. So CAPREIT clearly is the leading player. And Mark's been there for about 30 years, long time, and he's become a leading voice for the REIT sector, has been very engaged with government over the years. So it's great to have him here. So welcome, Mark.
Well, pleasure to be here as always.
So there's been lots going on this year, and I think on balance, it's been good news because we're finally getting the REITs back on the radar for investors. And perhaps the most important is InterRent, one of your competitors, well-operated business with a multifamily portfolio primarily in Ontario, being taken over by the founder together with GIC, a leading real estate investor, sovereign wealth fund out of Singapore. And then more recently, H&R, which has been around as long as CAPREIT. I was around when both companies IPO'd. There's rumors that it might be taken over or maybe a portion of its portfolio being acquired. And I think that's all very positive because we've had an extended period where the REITs were really out of favor and general investors, really didn't care about the sector. So it's back. So let's talk a little bit, Mark, about the whole M&A backdrop. In your view, does it provide more confidence to have a player like GIC coming back into Canada and particularly now focusing on the residential market?
Yeah, it's definitely a vote of confidence for the sector. I think all the REITs have been suffering from, I'll say, spooks in the market, and it's the healing time for those unexpected events tends to go much longer in the capital markets than it does in the private markets. What we've been saying at CAPREIT now, in terms of NAV, there's ample example of strong cap rates trading in the private market. And what we try to get across to investors is, and there is definitely a difference between an equities investor and a direct own apartment investor, is that when you look at the trades that are happening out there, there's indisputable disconnect between NAV and what we're trading at. And the concern is always on the macro political front is, I think in our case, the thing that's held us back. Whereas private investors just simply don't see that at all. In fact, what's been going on, really diving into the actual direct ownership apartment market, 98% of the apartment industry is in private hands. The REITs and REOCs are actually a very small percentage of the market. So for investors to not look at the 98%, is, I think, the disconnect that's getting missed out there. So GIC, I think, saw that. I think that the headwinds that apartment REITs have to come over with political pressures, with other explanations to investors, just don't match the kind of expected returns that people want. And I think GIC saw right through that. So when you look at the private investor market, apartments are trading really strong values. And when you look at someone like GIC coming in as a big money player, that's great validation for NAV.
So let's just double click on that for a sec because they had a 40-day go shop. No other buyer has emerged. So it sounds like Mike McGowan and GIC will be the successful bidders at $13.55. So what are your thoughts on that? What are your thoughts on the price they're paying to take this business private?
Yeah. Well, I think InterRent has done well in their bid. There's plenty of evidence that they bought at a very attractive cap rate. They may have had, I don't know at all, but they may have had an expectation of somebody else coming in to kind of surface NAV value. But it goes back to the simple problem of the world right now, not Canada. It's all around the world. The big capital is on pause, but the individual deal capital is alive and well. So when you're talking about writing equity checks in the hundreds of millions of dollars, it's a very limited buyer market. When you're talking about buying a single apartment building, it's almost an unlimited market. I'll throw in another example. In an effort to kind of help affordability, CMHC came up with this MLI Select program, which essentially allowed high leverage to be put on apartment buildings to maintain affordability and to do environmental initiative. And that brought in a lot of small check equity investors into the apartment market, which compressed cap rates. So it was interesting, a dynamic even underneath the sheets of what's going on, that the lowest cap rates are in the most affordable buildings because that's where MLI Select applies. So there's been changes to MLI Select, so we could see upward movement in cap rates for the most affordable assets. But where cap rates have expanded the most is in the luxury brand new, which is exactly the kind of product that we're interested in.
So last questions on InterRent. Number one, would this have been a portfolio that CAPREIT would have been interested in? I don't know if he participated in the Go Shop. And then number two, the actual price being paid, how do you think that informs the valuation, the IFRS NAV that CAPREIT is publishing?
Yeah. Well, all the REITs use a slightly different approach to valuation. I think we pride ourselves in being exceptionally conservative in our NAVs, and we have a very rigorous process that doesn't allow for management intervention, I'll say. Not all REITs do that. There is the ability for some REITs just to have management estimated NAV, which I think can be dangerous for investors or potentially misleading. But we've always maintained this very conservative approach. InterRent is an exceptionally strong management group. They are a great team, but distinguishing themselves to being different than the other apartment REITs. When investors look at liquidity versus operational performance, most often they'll go to liquidity. And, so I think that they had that challenge in front of them. And why we wouldn't be sort of a stalking buyer on that deal is that our strategy is around buying new construction assets that have far lesser CapEx burden attached to them. And InterRent would have just been adding more of the problem that we're trying to overcome. Great buildings, they're wonderful repositioning outfit, but not in line with our current strategic thinking. And Dean, at the end of the day, we always seem to do better on individual apartment deals than we do on the big M&A type deals. So, that would
Fair
be
point.
my answer. Yeah.
Yeah, fair point. Okay, let's talk a little bit now about the supply and demand fundamentals in the sector generally. You and I were talking a few minutes ago about this constant refrain that we have a housing shortage in Canada. And at the same time, you can't flip through a major newspaper or on LinkedIn where we see news about condos and developers going bankrupt in places like Toronto that have got all these new condos that nobody wants to buy, nobody wants to rent. How do I square this as an investor, as an observer?
I love this question. And I'll challenge anybody that's watching this to say, like, the first thing I'm going to say, it requires thought. You got to track what I'm saying here. It's not straight. Lazy thinking won't get you to the answer here.
Take us through
Okay?
it. Take us through it.
Okay. Canada is in uncharted territory right now. We have a housing shortage, okay? And we have an affordability crisis. But the affordability crisis is being this fire is being stoked there with rising unemployment and wage deflation. So coming out of COVID, as the example, when we saw all the exuberance, we had wages rising at unprecedented, never before seen levels. And we had an unemployment market that was absolutely stunning. And people were capitalized because they've been receiving subsidy and not spending a whole lot during the pandemic. A huge release of money, okay? Roll the tape forward to today, and you've got empty condos all over the city. And why is that? People can't afford them still. So this household consolidation phenomenon in Canada is very real, whether it be roommating or whether it be people living at home.
But that's due to affordability.
It's affordability. It's holding them back.
If I had a choice, I'd like to live on my own as opposed to bunking up with two other guys.
Absolutely. So So that concept needs to be given some thinking. There is a huge demand. And when you hit the right price, and we proved this out at CAPREIT, incentives, for example, don't work. They don't work anymore. Price point that people know what they're going to pay and they know what their budget's going to be, that works. And people want a surety as they get more nervous.
So how do we get to the clearing price, Mark? Does that condo developer, whether they go into bankrupt, somebody else comes in, drop their price, or are people going to be able to afford more because rates are coming down?
I think it's probably the first. You know, the reality is we use the example of what the heck is going on in Toronto, okay? And you and I were talking about the Toronto condo market, and it requires a little bit of thinking, okay? So what we have in Toronto is a preponderance of bachelor and one-bedroom apartments that even their price point today at $1,000 a foot is putting people in that $600,000 plus kind of market. That is unaffordable for even a six-figure income earner to be able to handle the living budget. And you and I were also talking about the confusing data. And so when we look at completions, if you go back 10 years, Toronto was probably, the GTA was probably, I don't know this for a fact, but it probably can be confirmed. Intuitively, I know this. Toronto was building 3 and 4 bedroom, single family detached homes in the suburbs of the GTA at rates at a pace never before seen. In fact, we ate up most of our land in building out mega subdivisions, okay? Those were counted as a completion. 1 single 4 bedroom, a completion. A completion today is a bachelor apartment. Huh. What's the number of bedrooms that we really should be thinking about? Not the completion number. 4 people live in a house or more.
We need better data.
We need better data. So not only do we know that the completions are well below CMHC predictions, caving and getting worse, they're not the same product. So the problem is absolutely acute, okay? On the developer front, what happened to these poor guys? And we can't lose them because we need homes. Who's going to build them? You can't suddenly have a grocer build apartment buildings. You need developers to build, so we have to keep them alive. But when they went through these post-COVID contract situations, inflation on everything, and the system wasn't working properly, so there was delays. All of those costs are in the deals that need to fail. And that's why they're sitting vacant, because they're not affordable. And we are seeing it on the rent side of the equation, okay? Our approach to new construction is the absolute best strategy we've ever had. We're cash flowing better than ever, but there is a limit. The rent growth is not there today. It will be when things stabilize out. But even on the rental market, people have household budgets, they have incomes, and there's a limit to what they can pay. Mm-hmm. And so the tilt between sort of the employer rules everything and can demand any price they want for work has been replaced with unemployment. And the unemployment rates in Ontario are really getting up there now and expected to get much, much worse.
So is this affecting your market rents at CAPREIT, and how are you dealing with it?
It does not affect our core portfolio at all. So the value add that we have, legacy properties that we have in the suburbs are still dramatically below market rents and highly, highly affordable, okay? They are maybe not affordable to some of the folks that live there because their income levels are quite low, but in terms of an offering to the marketplace, they're very, very affordable. So that stuff is bulletproof. What we're trying to avoid are these sort of nuclear drop zones like Toronto, where you've got this noise in the core, but you don't have it in the suburbs. So CAPREIT's approach to new construction is not downtown Toronto. It's kind of suburban Vancouver, it's Ottawa, it's London, it's Halifax, and it's Montreal, but not in the city centers. It's really in the suburbs.
So it sounds like you've been able to manage through this softening in the rental market, these issues in the condo market relatively well, just given the inherent nature of the portfolio. Is that a fair way to look at it?
Yeah, it is. And I think that what we're urging investors to do is that they're seeing cooling rents, but rent growth is still there. Mm-hmm. CAPREIT is still pushing out rent growth. And the confusion, especially with some of the US investors, is that they looked at the Sun Belt where they saw a rent regression, rents are actually falling, like entire building rent rolls falling. Mm-hmm. Our rent rolls continue to glide upwards, just not at the same pace that they were post-COVID.
And my last question is valuation. Do you think the market is properly valuing CAPREIT units right now in light of what's happening in the rental market, what's happening with supply?
Yeah, no.
Short answer is no.
Short answer is no. Income is still growing in the properties. If cap rates don't move at all, our valuation is going to continue to go forward. Okay. So we, again, at CAPREIT have not been, I don't think, appropriately rewarded for ever increasing our cap rates and therefore like holding our NAV very, very conservative levels. Because really what we've tried to do is when there's an absence of data in the marketplace, there's rent growth in the assets, but we're ticking up cap rates given the unknown. That's a super insurance policy. And that doesn't account for the land. That doesn't account for sort of the capital investments that have been made in our portfolio. And that NAV sits at $55+ and it's arguably extremely conservative. Not arguably, we've proved it with every asset that we've sold. We're selling above NAV. So like last year, CAPREIT, we sold $2.5 billion above NAV. That should have been enough for the marketplace. It shouldn't have taken an interest
market
rate.
didn't care.
Market didn't care. So for value investors, it's a great time for CAPREIT in particular. I'm feeling extremely positive, and Dean, I'm not always extremely positive.
Yeah, you tell it the way it is.
Yeah, I tell the way it is. And the way I describe it to investors is you are going to see moderation of rent growth, but that doesn't mean you're going to see a moderation in earnings, okay? Because rents are still growing and our cost situation is actually improving a great deal. So we're really focused on cash flow. We're really focused on a dollar is a dollar. And we're telling our people accounting doesn't matter. You focus on the actual needs and the most efficient use of cash, and it's paying dividends. So you'll see, I think, this strategy working quite well.
Well, this has all been very encouraging to hear because this is what we've been telling investors and our clients for a long time. We're finally starting to get some true catalyst events with some M&A activity, which I think is healthy. Although it's bittersweet, we're seeing some of our favorite names get taken out, but I think on balance, it's positive and the reason why we've got such a large weighting in CAPREIT in our portfolio. So Mark, thank you for this. It's been really great.
Yeah, thanks, Dean.